Hello, guys. Hello, everyone. This is episode number 10, part 2. In this, we're going to cover the rest of the macroeconomic fundamental indicators. In the part 1, we covered fundamental macroeconomic indicators such as GDP, gross domestic product, employment data, okay, inflation indicators such as CPI and PPI, interest rates, okay. And now we're going to cover trade balance, retail sales, and central bank policy decisions. All right. So let's start with the retail sales, okay, first, and then we're going to cover the trade balance. So before we go to the retail sales, I'm going to explain you more about the inflation indicators, okay, a little bit more we can so that we can develop our idea and extend it to the retail sales, okay? So as we know that the inflation indicators, let me switch to the whiteboard. As we know that the inflation indicators such as CPI and PPI and PPI, okay, they measure inflation. What they measure? They measure inflation. Okay, so PPI and CPI, they measure inflation, and inflation affects what? Consumer spending. Okay, inflation impacts consumer spending. Okay, now let's suppose when inflation is high, then the prices of goods and services and products will become more expensive. Okay, when the prices of goods and services are more expensive, then the consumer spending will decrease. Okay, when the inflation is high, okay, then the prices of goods and services will become more expensive, and therefore the consumer spending will decrease. When the consumer spending decreases, what happens? People buy less goods and services because the prices of goods and services are expensive. The people are discouraged to buy more goods and services, and rather they buy less goods and services. Okay, when they buy less goods and services, what happens? Government get less taxes. Okay, and at the same time, producers and sellers sells or produces sell or produce less goods and services. Okay, and when the producers and sellers sell or produce less goods or less services, then they will do the job cuts and less hiring. Okay, when they do the less jobs and less hiring, the country becomes less productive. Okay, the country becomes less productive. In the same way, when the government will get less taxes, then government will reduce its spending. Okay, when the government get less spending, or sorry, less taxes, then the government will reduce less spending. Okay, and when the government will produce less spending, there will be less economic development in the country. Okay, and when there will be less economic development in the country will become less productive. Okay, when the country is less productive, then there will be slow economic growth. Okay, it's very simple to understand. So let's suppose, okay, the inflation indicators are measured by CPI and PPI indicators. Okay, these CPI and PPI indicators measure the amount of inflation when the value of CPI and PPI is high. When the value of CPI and PPI is high, then the inflation is high. And when the inflation is high, then the consumer spending will increase. Sorry, then the consumer spending will decrease. In the same way, when the value of CPI and PPI is low, then the inflation will also be low, because CPI and PPI measures inflation. Okay, and when the inflation is low, then the consumer spending will increase. And when the consumer spending will increase, then what will happen? Okay, now let's consider this situation. We have when the consumer spending is increasing, and the other situation is when the consumer spending is decreasing. So let's start from here. When the inflation is high due to high CPI and PPI values, okay, the prices of goods and services will become more expensive, then the consumer spending will decrease. And when the consumer spending will decrease, then people will buy less goods and services. When people buy less goods and services, then the government will get less taxes. Okay. And when the government will get less taxes, then the government will reduce its spending. And when the government spends less on the economy, then there will be a less economic development or slow economic development. And when there is a slow economic development or less economic development in the country, the country will become less productive. And when the country becomes less productive, then there will be slow economic growth leading to the unhealthy economy. In the same way, when the inflation is high, then the prices of goods and services will become more expensive than we have already covered the high inflation. Now we will cover the low inflation. When the inflation is low, then the prices of goods and services will become less expensive. And when the prices of goods and services are less expensive, then the consumer spending will increase. When the consumer spending increases, people buy more goods and services. When the people buy more goods and services, then the government get more taxes. When government get more taxes, then the government will increase its spending. Okay, when the government increases its spending on the economic development of the country, then there will be more economic development. When there is more economic development in the country, then the country will become more productive. When the country is more productive, then there will be fast economic growth, leading to the healthy economy of the country. All right, that's it. In the same way, when when the inflation is low, then the prices of goods and services will become less expensive. Then the consumer spending will increase. When the consumer spending will increase, then the people will buy more goods and services. When people buy more goods and services, then the producers and sellers produce more goods and services. When producers and sellers sell or produce more goods and services, then there will be more hiring and job increase. When there is more job increase and more hiring, then the country will become more productive. When the country is more productive, then there will be a fast economic growth which in the country which will lead to the healthy economy. So I hope you understand how the inflation impacts the consumer spending behavior and how the consumer spending behavior affects the economy of the country. Okay. Now let's go back to the retail sales. Okay. Now retail sales data provide insights into consumer spending patterns, which is a key driver of the economic growth. Strong retail sales can indicate a healthy economy. It's very simple. Retail sales means retail sales means that how much producers or sellers are selling or producing. Okay. When the retail sales is high, when the retail sales is high, so the retail sales means how much these producers and sellers are selling or producing, how much. When the retail sales is high, then there will be, of course, more consumer spending. Okay. And when the retail sale is low, then there will be less consumer spending. Okay. So we can say that the retail sales is dependent on the inflation. When the inflation is high, then the retail sales will decrease. And when the inflation is low, then the retail sales will increase. So the retail sales is and is a derivative of inflation. It depends on the inflation. Okay. So let's suppose when the retail sales is high, okay, it means that there is less inflation. And when the inflation is low, then the prices of goods and services will become less expensive. Then the consumer spending will increase, as you can see here. When the consumer spending increases, then people buy more goods and services. Okay, when people buy more goods and services, then the government gets more taxes. And when the government gets more taxes, then the government will increase its spending on the economic development of the country, and then the economic development country will increase. And when the economic development of the country increases, then the country will become more productive. And when the country is more productive, then it will lead to the fast economic growth, leading to the healthy healthy economy of the country. In the same way, when the retail sales is low, or we can say when the inflation is high, then the retail sales will be low. Okay? Inflation is inversely proportional to the retail sales. Okay? Inflation is inversely proportional to the retail sales. When the inflation is high, then the retail sales will be lower. And when the when the inflation is low, then the retail sales will be higher. So let's suppose when the inflation is low, okay, then the retail sales will increase. Okay, there will be more consumer spending. Okay, and when the inflation is low, when the inflation is low, then the retail sales will be high, leading to more consumer spending. And now we have already considered, or we have already seen the situation of the more consumer spending. Now we gonna see the situation for the less consumer spending. When the inflation is high, then the retail sales will decrease. And when the retail sales will be decreased, there will be a less consumer spending. And when there is a less consumer spending, it indicates that the inflation is high. When the inflation is high, then the prices of goods and services will become more expensive. Then the consumer spending will decrease. Okay, when the consumer spending will decrease, then people will buy less goods and services. When people buy less goods and services, then government gets less taxes. When government gets less taxes, then the government will reduce its spending. When the government reduces its spending, then there will be a less economic growth or less economic development in the country. When there is a less development, there is a less economic development in the country, then the country will become less productive. When the country is less productive, then there will be a slow e- economic growth in the country, leading to a unhealthy economy. Simple. So let's cover it again. When the inflation is high, then the retail sales will go down. When the retail sales will go down, then this obviously means that the consumers are spending less money and the consumer spending is less. This indicates that the inflation is high. Okay. So the goods of services will become more expensive. Okay. When the goods of services become more expensive, the consumer spending will decrease. And when the consumer spending decreases, the people buy less goods and services. When people buy less goods and services, the government get less taxes. And when the government get less taxes, the government will reduce its spending. And when the government is reducing its spending, then there will be a less economic development in the country, and therefore the country will become less productive. When the country is less productive, then there is slow economic growth of the country, leading to an unhealthy economy. Now, let's look towards the other situation on the producers and seller sides. Okay. When the inflation is high, then the retail sales will decrease. When the retail sales is decreasing, there will be a less consumer spending. And when there is a less consumer spending, it indicates that the inflation is high in the country. Then the prices of the goods and services will become more expensive, then the consumer will spending will decrease. When the consumer spending decreases, people will buy less goods and services. Okay, when people buy less goods and services, then producers and sellers will produce less goods and services. When producers and sellers produce or sell less goods or services, then the jobs will decrease. And when the jobs decreases, when the uh, rates decreases and there is less hiring, so the country will become less productive. When the country becomes less productive, okay, then it means that there will be a slow economic growth leading to an unhealthy economy. So we're gonna just give you a simple idea here that inflation is directly proportional to the retail sales, okay? And consumer spending is directly proportional to the inflation. Sorry, consumer spending is inversely proportional to the consumer spending. Okay, so we can say that that inflation is inversely proportional to the retail sales, and the consumer spending is also inversely proportional to the inflation. Okay, when the inflation is high, then the consumer spending will decrease, and when the consumer spending decreases, this indicates that there are less retail sales, and we can say that retail sales is directly proportional to the consumer spending. Okay, so inflation is inversely proportional to the retail sales. Consumer spending is inversely proportional to the inflation. Retail sales is directly proportional to the inflation. Let me explain. Okay, when the inflation is high, okay, when the inflation is high, then the retail sales will be lower. Okay, when the retail sales are lower, this indicates that the consumer spending is less. And when the consumer spending is less, then the productivity of the country will also be less. In the same way, when the inflation is low, then the retail sales will be higher. And when the retail sales are higher, then the consumer spending is also higher. And when the consumer spending is higher, then the country will become more productive. Okay, so I hope you have understood everything. I have tried to explain everything in a very simple manner and in a layman terms. Okay, so I'm gonna just give you another objects as well. So I'm gonna summarize everything here. So first of all, these concepts, you have to understand these concepts. Okay, you have to keep these three concepts in mind. All right, I have already explained you a bit about it. All right, so let me explain you. First of all, inflation Inflation is measured by CPI and PPI data and PPI. So we can say that the CPI, inflation is measured by CPI. CPI predicts the value of PPI. Okay. And both CPI value and PPI value predicts the value of the retail sales. Okay. So let me give you an example. When the CPI data is high, this means that the inflation is high. And when the high inflation can also predict the high value of the CPI can also predict the high value of the PPI. When the PPI value increases, then the PPI value also increases. And both CPI data and the PPI data predict the value of the retail sales. When the CPI value is high and the PPI value is also high, then the value of the retail sales will be lower. Okay. Simple is that. Okay. In the same way, when the value of the CPI, okay, increases, okay, then the value of the PPI will also, sorry, when the value of the CPI decreases, then the value of the PPI will also decrease. And when both CPI and PPI value are decreased, then the retail sales values are increased. In simple terms, I can just draw a simple analogy here, and I can divide it into three sections: CPI, PPI, and retail sales. Retail sales, okay? So when the value of the CPI is high, this means high inflation. Then the value of the PPI will also be higher because the PPI value, because the CPI value predicts the value of the PPI. And when both CPI and PPI values are higher, then the retail sales will be lower. Okay, because the value of the CPI and PPI predicts the value of the retail sales. In the same way, when the inflation is lower, then the CPI value will also be lower. The CPI shows that the value of the inflation is low. Okay, if the value of the CPI is lower, then the value of the PPI will also be lower because the CPI value predicts the value of the PPI. Okay, which is PPI stands for the producer price index. CPI stands for the consumer price index. Okay, and when the value of both CPI and PPI are declining or lower, then the value of the retail sales increases because the retail sales is inversely proportional to CPI and PPI, and the value of the CPI and PPI predicts the value of the retail sales. Okay, when the retail sales are high, this means that the consumer spending is also high. So I hope you have understood everything regarding the retail sales, consumer spending, and the inflation. Now we're gonna understand the trade balance. The trade balance means the trade balance measures the difference between a country's exports and imports. A positive trade balance, which is also known as surplus, indicates that a country exports more than its imports, which can strengthen its currency. Okay. So now I'm going to discuss about the trade balance. Trade balance measures the value of imports and exports of the country. Okay, so trade balance measures the value of the imports and exports of the country. Okay, import means whatever the country is buying from other countries. Okay, so import means products and goods and services which country is buying from other countries. Okay, in the same way, exports means products, goods, and services which the country is selling to other countries. So, exports are the products, goods, and services which the country is selling to the other countries. Imports are the products, goods, and services which a country is buying from other countries. Okay, it's very simple to understand. Okay, now remember that trade balance is equals to imports minus exports. Okay, in economic and trade terms, imports are represented by X, and the exports are represented by M. So we can say trade balance is equals to X minus M, imports minus exports. Trade balance is also known as net exports. Okay, so trade balance, which is also known as net exports, it is imports minus exports. Okay, now to understand this situation and to understand everything about it, we need to have an idea. We need to develop an idea about exports and imports. So when trade balance is positive and increasing, this means that sorry, I write down the wrong formula. It should be exports minus imports. Exports minus imports. Okay, so trade balance, which is also known as net exports, is exports minus imports. So when the trade balance is positive and increasing, this means that exports are more than imports. So this means that country is more productive. Okay. And when trade balance is negative and decreasing, this means that imports are more than exports. So this means that country is less productive. It's very simple. Okay. So let me explain you more. So trade balance is a measure of imports and exports of the country. Import means the products and goods and services which a country is buying from other countries. Export means products, goods, and services which a country is selling to other countries. Simple as that. Okay. For example, when you are importing a rice, or when you are importing any electronic items like mobile phones, or like a mobile phones, laptops, or any other tech items from US to Pakistan, then it means you are importing. And when you are selling the the products to US from Pakistan, like rice, wheat, and other agriculture products, okay, you are selling these products from Pakistan to US, then it means you are exporting. So trade balance, the formula of trade balance is as follows. Trade balance is also known as net exports. And trade balance or net exports is equals to exports minus imports. Exports is represented by X, imports are represented by M. When the trade balance is positive and increasing, this means that there are more exports than imports. So this means that the country is more productive. And when the trade balance is negative and decreasing, this means that the imports are more than exports. So this means that the country is less productive because the country is buying more and producing less. And when the trade balance is positive, then the country is buying less from other countries and they are producing more. So they are more productive. Simple as that. And when the country is more productive, this means that we have high economic growth. The economy of the country increases, or the economic health of the country improves, or there is a high economic growth. And when the country is less productive, this means that there is less economic growth. Okay, this means that the country is less productive. The country is uh, the country is producing less, but it is buying more from other countries. So there will be a less economic growth in the country. There will be a less cash flow or money coming into the country. In this scenario, there will be a more money coming into the country. The country will have a good cash flow. And for that reason, the country will have a high economic growth and a healthy economy. Okay. So I hope you have understood everything about the trade balance. Now we're gonna go back to this one, central bank policies. So central bank policy decisions, statements and actions by central banks, such as interest rate decisions, quantitative easing programs, and forward guidance can have a direct impact on the currency prices. I have to add few more things here, which I maybe forgot to write it. Okay. So central bank policy decisions includes the statements and actions taken by the central banks. Okay. And what are those statements and actions taken by the central banks? These actions are the interest rate decisions. Okay. Okay. The interest rate decisions. Okay. The central bank decides whether they have to increase the interest rate or they have to decrease the interest rate. As I told you, when the interest rate is high, the people will borrow less money from the bank and they will invest and they will deposit more money into the bank, okay, in order to gain more interest from the bank, okay, because of greed. And when the interest rate is higher and people are getting more interest rate and profits or returns, they gonna increase the consumer spending. And when the consumer spending increases, then the country will become more productive. When the country is more productive, then the economic development of the country will increase, and the economic health of the country will also increase. Okay. In the same way, when the interest rate decided by the central bank is decreased, okay, so what will happen? People will deposit less money into the bank, and they will borrow more money from the bank, okay. And this will also decrease the consumer spending habits of the people, okay. And when the consumer spending are less, then the country is less productive. When the country is less productive, then there will be a slower economic progress or growth in the country, or the slower economic development in the country, which will lead to a unhealthy economy. Simple as that. Okay, the central bank also decides the monetary and fiscal policies. Okay, what are these monetary and fiscal policies? For example, they decide the exchange rate of the currency. They also decide how much taxes they should impose on 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 the financial transactions. So these are the monetary and fiscal policies. The third thing is the quantitative easing programs, and the fourth thing is the forward guidance. So all of these statements and actions by central banks, such as interest rate decisions, monetary and fiscal policies, quantitative easing, and forward guidance, they can have a direct impact on a currency prices of the country, and they will ultimately also impact the economic growth or economic development or economic progress of the country. That's it. Okay. So now we have covered various macroeconomic fundamental indicators. Okay. And here you can see here on the flow chart, I have summarized everything here. So macroeconomic fundamental indicators are GDP, employment data, inflation and CPI, trade balance, retail sales, central bank policy decisions, and interest rates. Okay. So don't worry about it. I'm gonna explain this in great detail, okay, as we progress through our mentorship, okay. And we will be covering both the technical analysis and fundamental analysis in our mentorship. And once we reaches the fundamental analysis, we gonna cover this topic in great detail, okay. So we're gonna cover everything about fundamental analysis. So this is just a basic introduction so that you can get an idea about the macroeconomic fundamental indicators. So I hope you have understood this video quite clearly. And now we're gonna end this episode number 10, part 2. In the part 3 of the episode number 10, we're gonna discuss macroeconomic news events that, okay, and those are the low impact, medium impact, and the high impact news events, macroeconomic news events. And we will also discuss the macroeconomic news calendar. Okay. Or, okay, we also gonna use the macroeconomic news calendar, okay, to identify the high impact news events, medium impact news events, and the low impact news events. Okay. So this is the conclusion of episode number 10, part 2.